Interest rates have exploded, and I know this seemed like it happened overnight. Oh. But if you've been watching this channel, you know that this isn't anything new. This is something that we have been expecting to happen, and it happened pretty quickly.
Wow, that was fast.
You know, just the other day I did a video and rates were at like 7.3%, and now they're 8.1% for a 30-year fixed mortgage. That's crazy, guys. But I did call it. I did call it. We just got here a little sooner than I thought we would, but I knew we were going to get to this point.
Yes, how do you know that?
My name is Orlando and welcome to the channel. Make sure you hit that like and subscribe button. It helps the channel. Guys, let's take a look at this. Look at the 30-year fixed mortgage right now. If you take a look at it, a 30-year fixed mortgage is 8.159%. Now let's take a look at the chart and you can see what I was talking about when I said it just came out of nowhere, right? But it didn't. Like we knew, I was following it. But it seemed like to a lot of people who are looking at these interest rates, it seemed like it came out of nowhere. And let's take a look at this chart. You see the blue line here, and then it just skyrockets. But the question is Orlando, why did interest rates go up like they did? Well, the 10-year treasury just went up above 4, guys. It just caught up with what's going on in the world, and that interest rate went up. As we know, the 10-year treasury is connected to mortgage rates. It's not exactly like the Fed raises the rates and that interest rate tacks on to mortgage rates. No, it normally is affected by the 10-year treasury going up, and it went up above 4 the other day. And so when I saw that, I knew exactly what's gonna happen, guys. But here's the thing, not only is this information great to know, this shows you this is on a $300,000, 20% down payment. Now, I believe the interest rate will be higher if you drop down the interest rate on a conventional loan. If you're putting down less than 20%, then I believe the interest rate will go higher than the 8.1%. Obviously, if your credit is below a 700, it also is going to rise. I believe that you can get to about 8.3, 8.4% the lower you drop your down payment and the lower your credit score is. So really watch out for that, guys. And the question is who's gonna buy in this situation? Who's gonna buy at 8.1%, putting down 20% on an overpriced home? That's right, overpriced. So you're gonna buy an overpriced home with an 8.1% interest rate? And let's not forget, guys, property taxes have went up, insurance has went up, and they have doubled, guys, doubled. This is crazy. Now, the one thing that I want you guys to remember is a lot of these guys, you will go on YouTube, you will listen to your realtor, and these guys will say,
hey, you know what? Don't worry, borrower, don't worry, client. These interest rates will go down before spring.
I even got a comment where someone said that a realtor told them that interest rates will be at 5.5% in the spring. Huh? So let's figure out when spring starts. Spring starts Monday, March 20th. March 20th. So you're telling me your realtor is telling you, and you need to run from that realtor. That's not me telling you a lie there. But listen, a realtor is telling you by March 20th, that's in 17 days, interest rates will be 5.5%.
Stop the cap.
What universe is he living in that he thinks that interest rates will get to 5.5%? That sounds like he's trying to get a commission. You know, a lot of these guys will tell you,
don't worry, just refinance.
And I have to say it every single time, guys. We're not, even though this is another reason why you should sit on the sidelines and wait. We are not focused on interest rates. We're focused on price. Price is what will tell you if you should buy the property. The interest rate, you know, what like the realtor says, you can refinance, but that's something you can change. You can change the interest rate if the interest rate comes down, but you cannot, and I will repeat, you cannot change purchase price. You cannot go back in time and then say, hey, let's drop down this purchase price. You can't do that. So you're going to be stuck with this overvalued home, this overpriced home that you believe will continue to go up, and it would only go down. And yeah, your interest rate in 2-3 years, whenever interest rates come down, yeah, you can refinance. Yeah, you can. But you still lost $100,000, $50,000, $60,000, $40,000 in equity. Now, how are you going to get that back? Is there any type of refinancing of purchase price? Let me know, guys. Maybe there's a different way to do this real estate game where you can figure out where you can reshuffle the purchase price and make it lower. I don't know. Let me know. It seems like these realtors are telling you guys,
Don't worry, 5.5% in 17 days.
when we just got up to 8.1%. But here, guys, before we continue on with this, let's take a look of what's the reason why I'm so adamant about this comment of the spring and these guys telling you that in the future, the price will come down. The Fed will hike interest rates higher if strong job growth and inflation continue. Fed governor says. Now, before we go into this, what are the chances? Think about this. What are the chances that job growth is going to continue to happen? And what are the chances inflation is still going up? I mean, we've seen it over and over and over again, and it looks like it's a pretty high chance that the numbers are going to correlate to what's happening here. It says the Federal Reserve will have to raise its key interest rate even higher than projected if the recent trend of surprisingly strong job growth in consumer spending and inflation persists. Now, I've been talking about this, and this is one of the big key items that is really pushing everything forward. Remember, we just talked about the continued credit spending of everyone. And we're continuing to see people who quote unquote are living paycheck to paycheck, spending huge amounts of money using credit, buying food, buying these things that have a lot of inflation attached to it, and it's not going to stop.
We have a problem.
Why is it not going to stop? Because credit card companies see a great opportunity to charge you more money, charge 21, 22, 23, 25% interest rates, and they see that opportunity to give that to you and you spend it. You will end up paying them forever, paying the minimum balance. And this is a great opportunity for them, but it's continuing to push up the market, and the Feds continue to see, wow, Americans are just continuing to spend more and more and more, and it's not their own money. It's credit that they're borrowing. Hence the reason why we're seeing this debt tsunami that's going to hit us very, very, very hard.
It's coming. It's headed right for us.
And then when we look at inflation is continuing to go up because, in my opinion, the Fed is always penny pinching when it comes to the rate increase. I have said that I think that they should continue to raise rates at a higher pace, at a higher amount, maybe do it a little bit more frequently. But hey, look, I'm not the Fed. He is quote unquote smarter than me. So, hey, I get it, whatever. But the point is I see this continuing in this direction. For some reason, job growth is still there, even though I believe job growth isn't as strong at the higher tier than as the lower tier. There are a lot of these small labor jobs, these beginner jobs that are available, right? Because people are spending more. People are still going to restaurants. People are still wanting what called low wage, hard labor type of jobs. That needs to be filled because we are still spending a ridiculous amount of money when we don't have it in our savings. And then it says the recent data suggests that consumer spending isn't slowing that much and that the labor market continues to run unsustainably hot and that inflation is not coming down as fast as we thought, said the Fed. If the data reports continue to come in too hot, the policy target range will have to be raised this year. I just hope that the Fed goes ahead and puts the nail in the coffin.
Hasta la vista, baby.
They are just trying to avoid what they consider toting the line of saying,
Hey, we don't want to put us in a recession. We got to make sure we don't put ourselves, we don't cause the recession.
hey Fed, listen to me. Let's look right here. Right. We're already in a recession. So you're trying to say we are not trying to cause a recession. You're not trying to cause something that we're already in. I don't know what it is. And the government changing the name of what a recession is. And we've been in 2 consecutive negative quarters for a GDP. We've done that already. We've done it already, guys. So for them to say, oh, no, we don't want to cause a recession, we're already in it. So at the end of the day, Orlando, what do you think interest rates are going to get to? Well, it's looking like we're going to get to that 9% range. That is where I believe that we're coming to. 9%. It's going to be rough, guys. Spring is not going to be all so happy. I've been watching these guys on YouTube. I've been hearing a bunch of pundits saying,
Hey, get ready. Spring is gonna be like it was 2 years ago, where you have 100 offers on a home, and it's gonna be the time for the realtors to get back and make all this money and be able to sell a house sight unseen with no appraisals, no inspections. It's coming back, guys. Get ready.
And I shake my head. I go, no. We're not going back to that era. We're not going back to that. And, you know, the market will not take it. And you sit on the sidelines. Good job, because you are not being pressured in this ridiculous FOMO. But as normal, guys, you will not get all of your information from this one video. I need you to watch this video here. It will help you understand what's going on in the financial market, get into your first rental property, and this crazy, insane housing market. And I promise you the information will be gold. And I will see you in the next one. Thanks.